All right, gang. Well, that is a minute past, so some other folks will probably roll in late, but that's okay. We'll go ahead and get things going here. So, a real quick intro to the presentation. I just sort of called this "Are You Serious?" I thought about calling it "Why So Serious?" but I thought maybe that might be a little much. Anyway, but we're just here to talk about a few different things. So today we are going to talk about first off, do you take your trading seriously? Because I think a lot of people don't, although maybe they think they do, because they equate being busy and doing stuff with being serious. And I don't think those are the same thing at all. Although certainly serious people can be very busy. But I don't think it's wise to confuse action with seriousness. So we'll talk a little bit about that. We're going to talk about some of our just very human weaknesses. We're going to talk about having an edge and, maybe explore the idea of, do you actually have one? And do you know? Are you sure you have an edge? Do you have the edge you think you have? And also, how consistent is that edge? Do you have consistency in your edge, in your approach? And then ultimately, can you scale it? Whatever you're doing in trading, is it scalable? Is it an approach that you can really, grow, or is it something that's just destined to always stay really small and never really gets you where you want to go? And then I'm also going to throw in a little pitch for the upcoming course, where we're going to build 6 different, and actually it's going to be 12 because there's going to be 2 versions of each one, but we're going to build 12 of these relatively simple TA oriented, totally automatic trading robots, bots, algos, whatever you want to call them. The cornerstone of that is going to be a bot framework, or an automation framework that you will have. You will build it yourself and you will have it forever. And in fact, I just did a session actually yesterday. It's on our YouTube channel. There will actually be a link to it, or there will be a link to the page that has it on there at the end of this presentation. So you can check that out. Where I actually used the framework, and I built a bot on the fly, and it took 20, 30 minutes or so to kind of build the thing. So that was fun. So you can check that out as well. The TLDR about me and TRG, frankly, you can just watch the last session I did. The last one I did, what was it, a week ago, 2 weeks ago? I can't even remember. I think it was last weekend. Actually, no, was it this past week? I don't know. Anyway, sometime in the last week or two. It's all a blur. But you can go check it out at trgp.nl, trgpnl. Why automate? It's also on our YouTube channel, and it's also going to be on the page that I will link at the end of this. So if you want more information about me and TRG in general and everything, it's all in there. So I don't need to go through that again. And most of you probably know me anyway, so it's not really an issue. So let's talk about some criteria that I am going to argue are really essential for success. I don't think as a trader, as an aspiring trader, anyone's going to get terribly far if they don't kind of tick these boxes, so to speak. And the first is, of course, based on the title of the presentation, take it seriously. This is serious business. And I think it's worthy of asking yourself, is this a hobby for me, or am I a professional? There's an old saying about hobbies. Hobbies cost money. Businesses make money, and a lot of people, I think, confuse the two. They take their hobby and they think they can monetize it, but they don't treat it like a business. They don't treat it as a professional. They still treat it as a hobby, and so it just winds up costing them money. And trading is an easy thing to spend a lot of money on, let alone losses. But it's a really easy thing to spend a lot of money on, indicators and systems and platforms and you name it. Really easy to do. Another thing is that professionals, they know every single one of their tools inside and out. They know all of their tools. And in the case of trading, that includes automation. Real pros, even if they aren't themselves into building bots, even if they're trading manually, they understand what goes into automation. And they're going to understand where they can maybe deploy certain elements of automation to improve their efficiency, to just make things easier for them. They can make them able to trade faster, better, whatever. You really need to understand all of your tools and make sure you use them. As an example, if you're talking about like a carpenter, is a carpenter ever going to not use a saw, right? They have a saw in their toolkit. They're not going to only use the saw. Of course, they're not going to always use it. But would they just decide, I don't do saws. Saws aren't really my thing. I'm not going to use a saw. Of course not. It's a tool. They're going to know all about it and know exactly how to use it even if it's not appropriate for the job at hand. Same kind of thing like a graphic designer, someone who lives in Photoshop, for example. Would they just never use the clone brush or the rubber stamp tool? I guess it's technically called. No, of course, it's not. You don't use it all the time. It's not for every single task. It's not for every single job, but you sure as heck are going to know how to use it and what it does. And you're going to know it really quite well if you're a professional graphic designer, if you're really serious. So you really, in my opinion, you really can't afford to just ignore automation. And I think a lot of people do, because various reasons, they think it's incredibly complex or they're not tech savvy or, they're not real computer literate. I hear that a lot. Now, I'm not very computer literate. Well, newsflash, you better get computer literate. I'm sorry, but that isn't just not going to work in today's world of trading. You need to be at least reasonably computer literate, and you need to be way more than just literate in your platform. You have to know all of the things it can do, and you have to know them pretty much like the back of your hand. So the second thing that's required if you're going to have success in trading is, for sure, we got to control the human, and that's us. Because we're always the weakest link in everything we do. We all have the capacity to be complete idiots. Maybe it's just me, but I'm pretty sure we've all done stupid things in trading before. Pretty sure we've all, decided, well, I'm down to the last $200 in my account, so screw it. I'm just going to put it all on this. I'm going to buy 10 out of the money calls with that $200 and hope for the best. And it'll either make me a big pile of money and I'll be back in the green again, or I lose my $200 and, whatever. I'll just fund the account again later, build some more money back up. Stuff like that, whatever. We all have the capacity to be just really dumb. There's, like I said, there's that temptation to go just all in on a trade. You can be glued to your monitors, just like, a junkie looking for their next fix, just trading round the clock, all day long. That used to be me during RTH anyway. I didn't trade evening sessions, but during the day, open to close, glued to my screen, staring at chart patterns, looking for something to do, and just jumping on things kind of semi-randomly without really knowing what the hell I was doing. How many times have we convinced ourselves that something is some kind of trade that we're thinking of doing or whatever that is clearly a violation of our process? We call those process violations in TRG, but it's clearly not in our rules, right? It's clearly breaking our rules, but we convince ourselves, nah, it'll be fine. This is okay. We're really good at doing that. It's ridiculous how good we are at convincing ourselves of things if we really want to. Another thing we all fall into the trap of at times is we're focusing on our P&L instead of our process. And if you focus on your process, the P&L just happens, right? You don't really need to worry about anything. You just focus on the process and let the numbers take care of themselves. But if you start focusing on your P&L, now you're chasing gains, trying to, get back losses, and it's just a total disaster. Another thing that I see all the time, and we are all guilty of at some point, is when we win, we result. We look at that and say, oh, well, I made money. So obviously I knew what I was doing. Obviously I made good decisions. Obviously I took good trades because I made money. And then when we lose, it's funny. We don't say, well, obviously I made a bad decision. Obviously I chose, bad trades. Obviously I didn't do the right thing. We don't do that. We blame shift. We move the blame somewhere else. Oh, well, that they took my stop or the algos got me or, whatever. Incredible how good at shifting blame away from ourselves we are when we do something that we know better. We know we shouldn't really have done. Next criteria is just having a real edge. And when I say a real edge, I mean something you can measure, like objectively measure it. You are not your edge. I am not my edge. No way. Absolutely not. Your edge is not your results. You don't look at your results and say, well, I made, $20,000 last month, so obviously I have an edge. Well, you might also have gotten lucky. That doesn't tell you anything about any edge at all. So you can't get an edge. You can't measure an edge from looking at your results. It just doesn't work that way. If you've got an edge, you know it up front. You know it in advance. An example I always like to refer to is, of course, the casinos, right? Las Vegas, Monte Carlo, wherever. Pick a casino. Casino builders, right? They don't invest, I don't know, what does it cost to build a casino? certainly hundreds of millions of dollars, right? Probably some of these places, billions of dollars. They're so ridiculously crazy over the top. But, certainly a ton of money. They don't invest a ton of money in building a casino and then let the people come in and start gambling and then look at the results of that gambling and say, do we have an edge or not? Let's find out. No way. Absolutely not. They know the edge of every single one of their games up front in advance before they ever break ground. And that's the benefit of a real edge is what that edge is up front and what you can expect from it if you just execute a consistent process. That's really where your edge shines. And a casino, to use them again, has a pretty consistent process, right? It's just get people in the door, get them to sit at a table, put a few drinks in them, get them not thinking clearly, and then let them gamble. That's the process. And then the money takes care of itself. They don't need to worry about it because they know they have an edge in the games. A real edge, you've got to have data. You can only measure it by data gathering. And really the only efficient way to do that, the only reasonable way to do that is to automate. Quote unquote back testing. I don't love that term because I think people have a tendency to associate that with things that I don't think are wise. They'll back test the system and go, oh, it back tested, it made money, it has this Sharpe ratio or whatever. It's going to work. And then they just put it live and it loses money and they don't understand why. We're going to talk a little bit more about that shortly, actually. Another big one is consistency. Like your process of what you do has to be consistent. You've got to have a process, first of all, but then you've got to be able to execute it reliably, consistently, the same way every time. You can't have room for just arbitrary discretion on your process. You can't some days decide you're going to follow this rule and some days not. That's not a process. That's discretionary, pure discretionary trading. And there are pure discretionary traders out there, but I would argue any of them who are successful, they are discretionary, but their process is built around that discretion. They still have a process. It's just that their process involves discretion as a key component of it, but they have a process and they're consistent in their execution of it. Another thing is start small. Because if you can be small but consistent, it is really pretty mind-blowing how fast this can add up. As an example, check this out. If you take a $500 account and you earn 3% per day, which at first glance you might think 3% a day, the bank doesn't even give me 1% a year, or I guess these days interest rates are up, maybe you get 3 or 4 or 5% a year. Now I really don't know. I don't have anything in any kind of standard banking account that's earning anything. But 3% a day sounds like a lot until you think, well, wait a second, what is 3% a day on $500? Well, it's $15. $15. So the question becomes, if you have a $500 account and you're trading micros, can you make $15 a day? What is that? That's like, I don't know, 12 ticks, something like that. Can you do that? Because if you can do that every weekday, every working day, and this calendar, of course, doesn't take holidays into account. It doesn't know about market holidays or anything like that. So it's just assuming every business day, but it's ignoring weekends. But still, it's in the ballpark. That account grows to $1 million in a year by 12 ticks. Because if you can add size, if you can gradually scale up, add size, and just keep hitting that 3% target, it's ridiculous what compounding does. And I know this sounds silly, but I'm running a bot right now that is doing exactly this. It's actually aiming for 5%. It has a 5% per day goal. And so far, I've hit it every single day for 3 weeks. I'm 3 weeks in on this bot, and it does its thing every morning. It takes 2 trades, and it's done. And I get my 5% compounded. And it's just sitting there chugging along. It's fantastic. So, small numbers add up. I know people have a tendency to look at the micros and they look at these small dollar amounts and they think, oh, wow, that doesn't mean anything. That's never going to get me anywhere. That's not going to amount to anything. Well, actually, it can amount to a lot. But you've got to be consistent or, it'll add up to a whole bunch of nothing. Last point that I have for the criteria anyway is whatever you're doing, whatever your approach is, you've got to have an ability to scale it. If it doesn't have the ability to scale, then it's never going to really go anywhere. It's not going to grow. It's not going to scale, obviously. And you can't just decide to trade more hours. Right? That's not a viable scaling method. Well, I'm just going to trade 8 hours a day. I'm going to trade 12 hours a day. Screw it. I'm going to trade 24/7. I just won't sleep anymore. I'm going to live on coffee. That doesn't work. You can't just decide to do that. You also can't reasonably juggle a dozen markets. Heck, I've traded two with some frequency, and that's hard. Just juggling two different domes, two different markets, doing two different things that aren't correlated. Trading oil and ES, CL and ES, for example, simultaneously during the same period. It's hard. I've done it, but it's really, really difficult. More than that, half a dozen, no way, I can reasonably do that as a human. It's also a lot better to trade a whole bunch of different markets and trade them really well to just get little bites of each one. Again, that 12 ticks I was talking about to get 3% on a $500 account. If you can get 3 or 4 ticks a day in this market, and 3 or 4 ticks a day in this market, and 3 or 4 ticks a day in that market, and 3 or 4 ticks a day in that other market, if you can have a half a dozen markets, each one getting, 3 or 4 ticks a day. And of course, tick values differ between markets, but you get the point. These small amounts add up, and you don't need these big, giant home run swings that people, desire to get. And I get why. I mean, it feels really good. When you catch a trade and you get 14 points out of it, it feels really good. I'm not going to lie. It feels really good. It is an awesome thing. But that's not something that you can just decide to go get. You can't really count on that. So if you want consistency, you're way better diversifying what you're trading, what your instruments are, and just trade small, get little gains in a bunch of different instruments. We humans, we get really greedy when we start to think about scale. I don't know about you, but I'm guilty of making plenty of spreadsheets where I just project a number out into like infinity and just, if I can just make this much, it's going to go forever. Kind of like this compounding experiment that I just showed, but like taken to a really, really silly degree. I'm guilty of it. I can't help it. The problem is that when we start to think about that scaling, we can get really stupid and we can start to make really bad mistakes. And especially our psychology can go a little nuts when we go from, maybe we start by trading a 1 lot, but then eventually we scale up to a 10 lot. Our brains can explode a bit. And we get freaked out and we start second guessing and thinking, oh God, I don't know. Now it's, especially if you're in minis, now it's $125 a tick. I'm 2 points off sides. Oh crap. It does things to us when we get that scale. So, it's better to have a machine do it, because a bot, or at least a well-made bot, is going to just do what it's supposed to do. Every time. It's always going to be consistent. It's not going to get freaked out about the scale. It's not going to second guess. It's not going to change its rules. It's got no discretion, et cetera. It's just not going to do any of those things. So all of these things are addressable through automation. And I think that is without a doubt the way to go. Now, let's talk about something that I put out there in one of my promo messages, which is how to, or one way. There's no one way, but here's a way of many. There's many ways, but here's a way to turn a losing bot into a winning bot. And this will not apply to every bot. Of course, it can't, because every scenario is different. Every situation is different. Everything every bot is attempting to accomplish is different, et cetera. So, this is not just a one size fits all. This will always fix your bot. But if you look at the stats, they can tell you what to look for, where to look for fixes to improve what's going on. In this particular example I ran, it lost money, right? But you don't want to just fixate on P&L. And that's a real standard thing to do. It's what I used to always do. Every time I used to try to build automation, going back years, first and oftentimes only thing I would look at was P&L. P&L and win rate, those two, because, I'm thinking like, well, I've got to have an 80% or better win rate, or I have no chance whatsoever. It's got to be this knock it out of the park win rate. And obviously that's better, but it doesn't have to be that way. But don't fixate on win rate. You got to ask yourself, well, what stands out to me about this? What else is there to look at aside from, sorry, don't fixate on P&L. I think I said win rate a second ago. I meant P&L. Don't just fixate on P&L. Ask yourself, what else is standing out to you in these stats? And in these particular stats, there's a couple of interesting things that kind of stood out to me. One is that just looking at the win rate, right? 55%. That's not great, right? That's, slightly better than a coin flip, right? That at first glance, I'm thinking, I don't love that at all. I'm not sure this has got anything even worth looking at, because I don't like anything that's that close to 50-50. However, I noticed something else. I'm looking at my average open profits and losses, open P&Ls. And it's kind of interesting because something did stand out to me here, which is that, my winners tend to have, of course, this is an average, understanding the limitations of averages, but they give you ideas of where to look. And in this case, the averages said that, my average winner has a pretty good open profit, and it doesn't have a lot of open loss. My average winner doesn't go heavily into loss, and my average loser doesn't go heavily into profit. They're basically mirror images of each other. But it got me thinking, I wonder, because this test was done running just simple one lots, right? That's it. Nothing fancy, no scaling, no position sizing, no nothing like that. So it got me thinking, what if I added position size to this? Because by definition, and if you don't know, by the way, I should mention, if you don't know about position sizing, if position sizing is foreign to you or you don't know anything about it, there's a lot of material out there on the subject. Van K. Tharp, he was the one who was my first exposure to concepts like expectancy and position sizing back 20 years ago. He's written many books on it, had lots of courses on it. He died not too long ago, I think like a year or two ago. But his material is still out there, and you can read up on it if you want. But one of the core principles of position sizing is that it's based on the amount at risk. And what that means is, done correctly, it will also keep you out of trades that are just plain too risky. And so this was kind of my thinking here with this example was, I wonder and this is one of my favorite things to ask. I wonder if, or what if, because that just always means now we're going to explore some fun things. And so my pondering was, I wonder if I were to add position sizing into this, because along with position sizing, by definition, has to have dynamic risk assessment as well. What happens if I incorporate this, and does it keep me out of some of the losing trades, and does it allow me to scale up on some of the winning trades? So what would happen? So we ran it, and this is more or less what it looked like before. So this is the before, right? This is what we were just looking at a second ago. So the first thing that jumped out to me on the new test with position sizing is that my win rate really didn't change, like a tiny bit, but it basically is exactly the same, which is odd. I thought intuitively that my win rate should change, but it didn't. It stayed pretty much exactly the same. Interesting. However, my open or my average winners, my average open profit and winners went up by about what, 3.5, yeah, like 3.5x or so. But my average loser, excuse me, my average open loss in losers went up by less than 3. So if my winners went up by more than 3 and my losers went up by less than 3, and I still have a better than 50% win rate, this should equate to a better P&L. And lo and behold, it sure did. Like way better, night and day better. Now, this is still not a set the world on fire bot by any means. And it has a few other issues that it needs tackling. It's got some aspects of its risk management that I don't like, and whatever. It's a work in progress. It's just something I'm toying with. But this one thing alone, which is really, it's two things. It's position sizing, and along with that goes risk control. It's just built in. You can't have one without the other. So they're two parts of the same thing, two sides of the same coin. But it made a big difference. So the lesson here for me is, don't just throw out a potential trade idea just because, it lost money. Okay, forget it and toss it. take a look at it, dig into your stats a bit and see what the stats tell you and say, well, what might I be able to learn from this? All right. I did see a couple questions here. So real quick, before I go any further, let me just jump in here and address them. Let's see. Roman, how many people do you know who really rely on trading in his earnings in percentage who trade? I'm sorry, Roman. I'm not quite sure what you're asking there. I apologize. I'm guessing English is not your first language, so you may be struggling to express what you're thinking. I'm not quite sure I'm understanding the question, and I would like to make sure I understand it so that I answer it correctly. So, are you by chance asking how many people do I know who trade for a living? Is that kind of what you're wondering about? Got it. Okay, good. All right. So I figured that out. All right, cool. Honestly, I know very few, very, very few. And I don't know any like I know of, but like people that I know personally, I don't know any who only trade for a living. I do know, I mean, Jeff and Lee from TRG, the TRG founders, both of them definitely make a significant portion of their total income from trading, but it's not their only source of income. They have multiple streams of income, which I think is just always a good idea. I've always felt that. Well, at least going back. Oh, when did I first learn about the idea of multiple streams of income? That would have been around 2004. So yeah, 20 years or so. I've been focused on trying to have multiple streams of income. So I definitely recommend always try to have different streams. And they may all be around trading. They may not. Lee, for example, he's got his trading income, but then he also runs TRG. He's also got his emoji trading studies, Sierra Chart Studies company. So he's still, they're all around trading, but different aspects of trading. And that's kind of the direction I'm heading to. Obviously, I'm teaching these classes now and this kind of thing. So, because that's just something I like to do, and I like trading. So, combine the two, and I get to still do more stuff around trading. So yeah, I know very few people who make their sole. Well, actually, I don't know anybody who makes their living solely from trading and nothing else. Let's see. Samir, never found anything that works. Yeah, that's not too surprising. Most people who sell make their bread and butter from sales. Absolutely. Yes, Samir, you are 100% correct. That is very true. And in fact, I'm gonna talk a little bit about that in just a minute. So you've kind of teed me up for one of my upcoming slides. So thank you for that. Roman, what is the average broker commission for a trade? Well, I don't know about an average. It's really going to vary. I know that on the performance account that I'm trading, the particular bot that I was just talking about a minute ago, that I'm actually running. I've been running for 3 weeks now. I'm running that on an Apex performance account that I have there, and the commissions for them, I'm doing micros, are $1.02, I believe, if memory serves. In ES, I think it's the same for all the equity equity indices. Ugh, that's hard to say. So yeah, it's $1.02, I believe, per contract. So yeah, the commission structure is not as good with micros, but it gives you additional granularity in your scaling. And when you're dealing with small amounts, especially, you just minis aren't an option. If I'm dealing with a $500 account or $500 in drawdown or whatever, minis, just way too much leverage. I need to go smaller. And so, I might be okay doing a 3 or a 4 lot of micros, or maybe even just a 1 or 2 lot, depending. But I can't do minis. It's too big. Now, once I scale to a certain point, yes, absolutely. And then it gets even more efficient, and the scaling can start to ramp up even faster. But you got to get to that point. And to do that, you got to stay small, stay consistent, and just grind it out. So yeah, and every broker is different. Actually, my commissions are cheaper, I know, on my cash accounts at AMP and Iron Beam. It's been a while since I've looked at the commission structure. My memory is telling me it's like 89 cents a round trip, I think, for a micro. Minis was $3 and $3.98, $3.89. I feel like that's right, something like that. I don't remember offhand. You can look all this stuff up online, but it varies. It's all over the place. But it shouldn't make a huge difference. That's an important point to bring up. Is if your approach doesn't work because of commissions, then you don't have enough of an edge. I mean, it should work better with better commissions, but commissions should just be a cost of doing business, and they shouldn't make or break your system. If it does, it's a problem. Let's see, Roman. You're able to make $50 to $100 a day, but you spend almost everything on commission. Okay, well, that's a good start. You're starting off in a good direction, at least, because I would argue that most people probably lose $50 to $100 a day and still spend money on commissions. So, hey, you're at least, if you're break even, honestly, if you are break even consistently, that is a really good place to be at. Consistently is the key. Because if you can maintain break even, over time, then that shows that, okay, you do know something about what you're doing. You've got something that is at least not losing you money. Then the question becomes, okay, what can I adjust? What can I optimize? What do I need to change about what I'm doing? Which then, diving into your stats, looking at your results and figuring out, okay, when I lose, why do I lose? What happens there? You're usually going to learn the most from your losses. You're not usually going to learn a whole heck of a lot from your wins. Wins are more fun to look at. Obviously, we all like looking at our wins more than we like looking at our losses. But our losses are where we learn. So those are really the useful thing to be looking at. All right. So thanks for the questions. Now, the next question for my presentation becomes, how do you actually do this? Because it's great to look at these numbers and, whatever, that's all neat. But how do you actually build a bot? Well, the first thing you got to do is know how to automate. And this is where the upcoming class that I'm teaching is going to get into. We're going to dig deep into how do you automate, but we're not going to be getting into code. Watch the other video from a week or two ago if you want like all the real nitty gritty details about the course. I'm going to just give highlights here, but we're going to keep it simple, and we're going to build a framework just like what you see right here. In fact, this is the framework, or at least most of it that would fit on the screen. And you can just feed whatever you want into it. This was the session I just did yesterday, and you can see me using it. And I built a bot in about 30 minutes. I built an order flow bot, and it becomes really, really easy to test ideas once you have this framework. You just drop it onto a chart and off you go. So again, we're going to build 6 bots, 12 actually, because we're going to do 2 versions of each one, and we're going to use a variety of the popular TA techniques of today, and frankly yesterday, because these are all old. We're going to use the replay system. To gather data on what happened with the bot. What did it do? Wins, losses, and all that. We're going to look at all the stats. We're going to figure out what to do with them. We're going to go pretty deep into how to optimize your replays, because if you've ever spent any time with Sierra Charts replay, it can be pretty bad. It can be really slow. But there are a lot of ways you can improve it and speed it up and make it more performance. And so we're going to work on that. We're going to really dive into that. And then we're going to look again, like I said, at the data. We're going to look at the results of the back testing. I don't like that term, but yeah, the replays. And we're going to figure out, all right, what do we need to learn from this? What can we learn from this data that we can feed back into the bot to try and improve it and see if we can make it better, turn it from, maybe it's a loser back into a winner, or, whatever. We'll do something, but we will be able to make a difference. All right, so we are going to build. Here's the system we're going to build. We're going to start with a moving average crossover. We're going to build a range trader. We're going to build a mean reversion bot. We're going to build a TTM squeeze bot, just because that's a popular thing that people still like today. We're going to build something around the Camarillo pivots, because people also love their pivots. And we're going to build a divergence bot. I'm going to use volume divergence just because it's easy to understand. It's not too technical, not too complicated, but you could plug in whatever you want. It can be a divergence of anything against anything. So it's a very universal, flexible bot. Now, there is this thing you may have heard of, and it is called survivorship bias. And this is really important. This goes to what you were just talking about, Samir, about people selling, frankly, to be blunt, crap, selling BS systems that don't make money, will never make money, but they look really good. They look at a historical chart and they throw up signals, and it's like, oh man, this thing, it would have bought here, it would have sold there, look how much money it would have made, and they look fantastic. Here's the thing. Survivorship bias is what we're seeing when we look at historical charts. If you don't know what survivorship bias is, this is a very famous picture. This one happened to have a cat on it, so of course that was the one I had to grab. So don't ask me why the cat is there. I don't know, but it was cool, so I kept it. And the idea was, in World War II, the military was, some bombers made it back, right? Some got shot down, but some made it back. And they limped their way back to base. And so they wanted to look at those and say, wow, okay, why did these ones make it back and the other ones didn't? And they looked at the bullet hole patterns, right? And this is what the kinds of patterns they saw. And their first thinking was, oh my God, look at where it got shot. Look at all the bullet holes. Okay, we need to beef up the armor in these locations. Everywhere there are lots of bullet holes, that's where it needs more armor. Actually, that's completely backwards. In reality, those are the places that could get basically shot to hell and still survive. Those are the places that didn't need more armor. And this is proof that they didn't need more armor, because look how many shots they could sustain and still come back. The thing is, they were not looking at the planes, rather. They were not looking at the ones that didn't make it back. They were only looking at the survivors. So hence survivorship bias. And here's the thing about chart patterns. This is survivorship bias. All of these patterns, when people show them on a historical chart, and they have their pretty little arrows, red and green arrows and dots and, whatever else, showing you where this system would have done this and would have done that and blah, 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 blah. It's nonsense, because they are looking at the survivors. They're looking at the cups and handles or the bear flags or the rounding bottoms that survived. They're not looking at all the ones that formed along the way and then failed, that would have gotten you into a trade and cost you money. So please understand that when you see people promoting, selling a system, a black box for 10 grand or, whatever, all this nonsense that's out there, understand they're showing you a textbook example of survivorship bias. Now, if they show you a forward replay of what it did on actual market data over an arbitrary, random sampling of time, something that wasn't in their sample set that they built the thing on, that's a different story, because then that is going to be trading forwards and evolving over time as the market changes. But when you just see these people showing historic charts with dots on them and lines and arrows and whatever, that is total nonsense. It is the literal textbook definition of survivorship bias. So just keep that in mind when you see people promoting a pretty looking chart that has, made lots of money all over it. All right. So real quick, the total workshop is 13 weeks. There's going to be 13 live interactive classes. It's going to be well over 20 hours. And 20 hours is a very conservative estimate, but that's the theoretical schedule time is 20 plus hours. It includes both of or actually all four of our online courses at TRG, the Tickmaker courses, 2 Tickmaker courses, and 2 Get Funded courses. And those are a really good prerequisite, in fact, for the upcoming class. Private stream in our community, The Pit, for 24/7 chat amongst your peers and myself as well. You're going to have totally permanent access to all the recordings, because everything is always recorded. We record every class, put it in the library, and all students will have access to them forever. So you can always review, which is really, really important for such technical stuff. You need to review it. You're not going to get it all from one viewing. You're going to get step-by-step workflows from me for building every bot, which is in addition to the video of me actually building the thing. I'm going to give you basically think of it as a PDF of a step-by-step screenshots of here's every single thing you do along the way. You'll get the chart books, you'll get the spreadsheets, you'll get the formulas, you'll get, everything we do. I will hand everybody. However, I am going to expect everybody to build it themselves first. That is critical. If you want to really learn this and you don't just want to be another passive consumer of trading products, which I don't think that benefits anyone. It's important that you do the work. All right, tons of live Q&A time with me, and then of course, as I mentioned, access to me through the pit, because I'm basically always there because I pretty much have no life. So this is the schedule. All the classes are going to be on Saturdays at 11 a.m. Eastern, and it's going to be $1,000, $999 to the public. But right now there is still an early bird discount of 30%, a $300 discount, so $699 until Monday, December 18th. So the class is about a third full right now. Well, not full as in like I'm cutting it off at a certain number, but based on what I'm expecting, based on past classes, I know roughly where we'll probably land in terms of attendance. And right now we're at about a third of that. So there's definitely room left, and you can save $300 until Monday. So I encourage you to go check it out at trgp.nl/automate, trgpnl/automate, and that page that it will take you to, it will redirect you to a page on the TRG website, has the videos that I was talking about. It has yesterday's session, the build a bot session, where I actually build a bot using this framework, and it has the previous webinar from a week or two ago, whenever it was, where I gave a lot more detail on the course and really went in deep on it. So if you want to know more about that in detail, just go watch that video. That's your best bet. So that is the presentation. This wasn't meant to be a super duper long, deep one or anything like that. I just wanted to give you some thoughts, some things to think about, and remind everybody about the class coming up and about the early bird pricing going away after Monday. So got through the weekend to decide if this is something that you want to get involved in. If you want to reach out to me, you can do so. You can reach me social media, Twitter, Facebook. Yeah, I mean, obviously you found out about this through some mechanism where you have a way to contact me. So find me on social media, find me in the pit if you're in TRG or you're a student of the online courses, whatever. I'm very easy to find. Look me up on Facebook, whatever. I'm not hard to find at all. Thanks for coming, checking it out. And for those of you who are already registered on the class, it's going to be a ton of fun. I'm really looking forward to this. I've been putting a ton of work into the material for this class, so it's going to be really, really good. Thanks, everybody. We will talk to you real soon. TRG folks, we'll see you in the pit or for Jeff's session tomorrow. Have a good one, all. Bye-bye.